Vanakkam Mankale. Do you guys remember in school we used to get ranks based on our scores? Credit score is like that, but it is given for your financial habits. It is given out by 3 credit bureaus in the US: Equifax, Experian, and TransUnion. Now let's see why these scores are important. These scores are not given by these credit bureaus just for fun. They are actually giving it to your employers. They are giving it to credit unions, banks, rental lease agencies, and even insurance companies. They use these credit reports to see if you're fit to be employed, or you fit to get a loan, or you fit to even rent, and sometimes even insurance rates will depend on your credit scores. Let's put this into perspective, right? Let's say you want to buy a $500,000 house, right? If you have a good credit score, you will be paying around $2,400 per month as EMI for a 30-year fixed rate. Let's say if your scores are bad, you might even pay somewhere around $2,630 per month. You might think it's a $200 difference. You know how much interest you pay extra over the course of 30 years? Can you guess? Do you think it's 10,000? Do you think it's 20,000? Do you think it's 30,000? No, it's actually $86,000 difference over the course of 30-year mortgage. That's a lot of money. Let's see how these scores are calculated. There are 5 main factors that are used to calculate these scores. 2 of them are very important. One is payment history, 2 credit utilization. Let's see about payment history. Payment history is whenever you get a credit card bill, car loan bill, house loan bill, these are not just sent to you, but these banking institutions also send them to the credit bureaus. These credit bureaus make a note of this, right? And whenever you pay these bills on time, these are reflected on your credit reports as well. How do we use this to our advantage? Keep paying all your credit card bills, house loans, and car loans on time every single month. Every time you pay on time, your score keeps going up. Let's talk about credit utilization. Credit utilization is nothing but how much of the available credit are you using. So let's say you have a credit card with a $1,000 limit. Ideally, you should use less than $300 or 30% of the total available limit. If you want to go further and look better for the credit bureaus, use only 10% or $100. When you use small amount of your credit and you pay them on time, it reflects well on your score. Payment history and credit utilization. These two are the 2 things I personally call the VIPs of credit score, because if you just take care of these 2 things, your credit score invariably will get better. The next factor is length of credit history. Longer the credit account is open, better it is. Let's say for an example, you have an old credit card with no annual fee. Try to keep them as long as possible, and make maybe a few couple of bucks charges here and there, and pay them in full and keep them open for a long time, so your credit score will get better. Credit mix. This is something I personally don't like much. What basically it means is the credit bureaus want you to manage multiple credits like credit card, car loans, house loans, and they want to see if you can manage different credit loads and pay them in full, and are you being responsible. Just because you want to improve your score, it's not a good idea to go open multiple loans. You use only loans you need. So, but it adds to your credit score. So just saying it part of the video, but it is not important. So the 5th factor is new accounts. Whenever you open a new account, either it be a house loan, car loan, or credit card, this will reflect bad on your credit score. The reason being, the credit bureaus think you are a riskier person because you are taking newer loans, so your credit score goes down. But it's only for a few months. If you keep paying these new loans on time and keep your credit utilization low, your score eventually will come up. So to recap, 2 main VIPs are the payment history, which accounts for 35% of your credit score. Your credit utilization accounts for 30% of your credit score. Length of history accounts for 15% of your credit score. And the last 2, new accounts and the type of credits mix, that accounts for 10% each of your credit score. Now let's look at the range of these credit scores. Anything less than 600 is considered poor or bad, and if you are between 600 to 670, it is considered fair. If you are between 670 to 740, it is considered good. Between 740 to 800, it's very good, and if it is more than 800, it's exceptional. Try to be in the very good range between 740 to 800, because if you go beyond 800, I don't think there is any benefit, and you get all the benefits of a good credit score if your scores are between 740 to 800. Let's see how to get these credit reports. Government has made it easy for you to get a free annual credit report every year. So you can go to the link I'm going to give it below. It's a government website. You can request your credit report. Ideally, I would suggest to get these credit reports every January, so you can know what all the credit cards you have opened, all these different loans you have, and you can also see if you're paying them on time. Second option is whenever you get a credit card or any kind of loan, the banking institutions check your credit score. You can ask these institutions to give you a copy of the report. Third thing, you can use these free softwares like Credit Karma. They are like a weekly credit check agencies. They all give you an estimate of your credit. It's not the true credit score. They give you an estimate based on the system where your credit score lies. The primary reason why you need to get a credit report is sometimes there are errors. These are not institutions that are looking out for you, right? Sometimes there are errors that are reported to these credit bureaus and ended up affecting your credit scores. So if you find any errors in your credit report, you can call and dispute these errors and make sure these errors are taken out so your credit score goes up. Sometimes your identity can be stolen. Some people can use the information that they might find online about you and use that and get credit cards, house loans in your name, and you will find out only when you get these credit reports. So there is a superhero move I suggest everyone do this, called freezing your credit. What basically it does is you call these 3 credit bureaus and say you want to freeze your credit reports. What it basically does is no one can steal your identity and take loans under your name. I would suggest, if you're not looking for any credit card or any house loan or car loan, do this. And when you want to take any loans, you can call these credit bureaus and say you want to unfreeze this account for a period of, let's say, 2 weeks when you're looking to get a loan, and then freeze it back. And especially if you have kids, I would suggest you freeze your credit reports now, because anyway they are not going to look for any credit cards or house loans. So try to protect their identity, because you will never know. They might be 18 and then they will find out their identity was stolen a long time ago. So in summary, credit score is like a rank given to you by these credit bureaus for good financial habits. Use this to your advantage to save thousands of dollars in interest over time. Remember the 2 VIPs: pay your bills on time and keep your credit utilization less than 10%. Check your annual credit report in January. Make sure there are no errors. If you find any errors, dispute them, and please freeze your credit reports when you're not using them. So more such topics to come in the upcoming videos. So let's talk money.